Today we're tackling one of the biggest questions in engineering economics. How do you compare different investment alternatives? There are 8 discounted cash flow methods for comparing projects. The present worth, or PW, method takes all the future cash flows and translates them into today's dollars. The future worth, or FW, method moves everything to the end of the planning horizon and then compares them. The annual worth, or AW, method spreads the project's value evenly across years, turning everything into a per-year number. The capitalized worth, or CW, method finds the present worth over an infinite horizon and is great for projects that could last indefinitely. The discounted payback period, or DPBP, method tells you how long it takes to recover your investment once you account for the time value of money. The benefit-cost ratio, or BCR, method compares benefits to costs. If the ratio is greater than 1, the project is worth considering. The internal rate of return, or IRR, method looks for the interest rate that makes the project break even. Basically, the project's personal rate of return. The external rate of return, or ERR, method is similar to the IRR method, but assumes reinvestment happens at your required return, called the minimum attractive rate of return, or MARR. Each of these 8 methods fall into 2 groups: ranking or incremental methods. PW, FW, AW, CW, and DPBP are ranking methods that involve ranking projects by the selected DCF value and picking the best one. For example, the project with the highest present worth or the shortest payback period wins. BCR, IRR, and ERR are incremental methods. These compare one project against another and ask, is the extra investment worth it? 6 of these methods, PW, FW, AW, IRR, ERR, and BCR, are actually equivalent. If you apply them correctly, they'll lead to the same recommendation. The exceptions are capitalized worth and discounted payback, which can sometimes point you in a different direction. We will go into more detail on each of these methods in later videos. There are a couple of important considerations when comparing these alternatives. First, consistency is key. When using a measure of economic worth to compare investment alternatives, you must choose to use the before-tax or after-tax value of these cash flows. You cannot mix the two. Additionally, if you're using before-tax cash flows, you must use a before-tax MARR. If you're using after-tax cash flows, then use an after-tax MARR. Second, projects don't always have the same lifespan. To compare them fairly, we use a common planning horizon. If a project lasts longer than the horizon, we include a salvage value. If it's shorter, we assume it'll be replaced and add those replacement costs. Lastly, doing nothing is always an option. When you're deciding whether to invest, you're really asking, will I make more money with this project or by just keeping my money in an investment that earns my minimum acceptable return? When using a PW, FW, or AW method, invest if the value is greater than 0. With BCR, invest if it's greater than 1. With IRR or ERR, invest if the rate is higher than your MARR. With DPBP, it depends on your cutoff for payback time. We will go into what this means for each method in later videos. So here's the big takeaway. You've got 8 methods to compare investment alternatives. Some methods rank projects, some compare increments. 6 of them are equivalent, which makes your life easier. Always consider taxes, project lifespans, and even the option of doing nothing. That's it for today's lesson. If this helped you, hit that like button and subscribe for more engineering economics tips. Thanks for watching, and I'll see you in the next one.